I'm sure we can all agree that the energy transition will require a massive level of investment in scaling up low-carbon solutions, and at BNEF, we believe that is what will help us scale down fossil fuels in order to meet our climate goals. That level of investment will pose a massive financial opportunity to the folks in this room. One of the ways in which we can wrap our heads around the scale and pace of that transition is the ratio over time of low-carbon investment to that of fossil fuels. And so how have we been performing on that metric historically? Well, we've actually seen quite a bit of progress. Up until around 2010, we saw less than half the amount of low-carbon investment relative to fossil fuels. Today, in 2022 and also in 2023, we see around parity, so 1-to-1 low-carbon versus fossil fuels. Now, Dana hinted at this earlier, but if we are to look at 1.5-degree consistent climate scenarios as a guide for where we need to go on this metric, we would find on average we need to see 4 times as much low-carbon investment as fossil fuels this decade, and that climbs over time to 6-to-1 in the 2030s and 10-to-1 in the 2040s. Now, keep in mind, we're already a large part of the way through the 2020s. So this really rapid and smooth trajectory implies that we would have a growth and very robust clean energy market globally and here in the US. And so my colleague Rob looks specifically at the companies that are building out this infrastructure and investing this capital. And so are we seeing this rapid growth?
Well, first, I'm excited by the idea that clean energy or energy transition spending's at parity, about $1 trillion a year. And the idea that it could go to 4x by 2030, that's music to my ears. It didn't sound like folks in the room really believe that number, but I think 4x by 2030 is actually pretty achievable. Off of a 2022 baseline, that's a CAGR of 20-ish%. So that's doable by what I believe is a growth industry. Now, if you do believe that something like this, or at least moving in that direction, is going to happen, you don't really see it reflected in the stock market right now. So if we could take a look, solar stocks, the bottom line here, they're down 30-40% year to date, depending on which index you look at. This compares with a global market that's up. Energy stocks, more oil and gas weighted, are kind of sideways for the year. So solar investors, solar companies don't seem to have sold the narrative that this kind of 4x, 6x growth is coming down. Maybe I can explain a little bit of what's going on there. So with the next slide, on the left is the annual global solar PV additions. This is probably my favorite hockey stick chart in existence. I think it's just exciting to see this idea of the rapid growth in solar installations. This isn't a forecast. This is just the reality. I personally believe a terawatt per year of installations within reach sooner rather than later. Now, solar sales, if you look at U.S. listed securities, there aren't too many solar companies you can invest in, kind of 8 to 10, depending on how you draw the lines. And they've actually sort of mirrored that trend. But here in 2024, we've actually seen a little bit of a pullback. Well, what's going on? One is we've seen a big decline in solar module prices. Dana mentioned LCOEs. That's ultimately good for the consumer, but a little bit not great if you're trying to deliver revenue growth. And there are a few other headwinds that maybe are driving sentiment around the space. I'll quickly march through those. First is we continue to see difficulties with grids and permitting. When the Inflation Reduction Act was passed, Senator Joe Manchin actually had a piece of companion legislation that was trying to speed up permitting around wind projects, transmission, solar pipelines, and gas as well. He couldn't get that coalition built to get the thing passed, but this is still sort of a perennial challenge with getting some of these projects across the finish line. Another big issue is supply chains. Look, during COVID, a lot of companies got caught short. They couldn't deliver products that individuals wanted to buy. So we saw following COVID, a lot of companies built up their inventories, and they actually got a little bit too bloated in the solar space. So we're seeing, in wind space, so we're seeing some destocking happening right now. And then the last piece that I think folks in this room would be familiar with is that interest rates really rose quickly, and that affects the economics of doing solar, particularly on the residential side of the business, because we used to have 3 large residential solar names in the U.S., SunPower, Sunrun, Sunnova. SunPower went bankrupt in August, probably or partially related to this rise in interest rates. And so rates are the sort of final piece of the story that are maybe affecting sentiment here.
Yeah, and I would say this also really affects the corporate banking and investment banking side of things, which is really what I focus on as a sustainable finance analyst looking at banks. So just as a quick reminder, I'm sure we're all familiar, but central banks across the globe rose rates at a rate that we haven't really seen in recent history. So here in the US, we saw rates go from virtually 0% to over 5%. With the first cut just being last week, that half-point cut that you see at the far right. And hopefully this is an indication of where things are going to continue to move. But for the past few years, we've all been operating in this really high interest rate environment. And we see the effect of that at the macro scale on bank-facilitated financing in the energy sector. So here in North America, we track both on the low-carbon side and on the traditional energy side. So both sides of the energy transition, bank-facilitated financing went down over a quarter between 2021 and 2022 as we saw rates take the most dramatic increase. And so what does that look like on the individual institution level? We also look at this by bank. And so for the 5 largest banks in the US, we also saw energy supply financing on that institutional level take a similar decline. It depends on the institution. Ranges from 16% to over a third of a decline. And so that's not just for the data that we track at BNEF. It also shows up in bank-reported data in their own ESG reporting. So all of these banks have an ambitious sustainable finance target. So some will say, we'll finance $1 trillion toward climate solutions and other sustainable financing by 2030. And they report against that progress in each of their ESG reports. And so we also track the numbers that they're reporting year over year, their progress toward that target. And each of these banks reported themselves a pretty large decline between 2021 and 2022. In 2023, for most of these banks, it either sort of leveled off or continued to slightly decline. And so perhaps that's an indication that despite the high interest rate environment, things are beginning to even out as companies and banks adapt to that. That's on the financial level. How are you seeing this flow through to companies?
Yeah, so never having seen this slide until a few minutes ago, I just thought, well, how can I tie it into what's going on in the solar space? So if we go, look, solar, this is a chart, kind of heat map showing revenue growth by quarter for the solar names that are listed in the US, and we really saw things kind of hit a wall in the second half of last year. So the idea that if financing starts slowing down in 2022, you don't immediately halt projects or anything like that. So I think you saw it hit revenue for the companies last year, and we've seen it continue into this year. Now, I would like to make the case that we can be optimistic about a turnaround for this space. And let me see if I can tell that story quickly here. So when I think about solar names, energy transition names, I think there's 3 really cool drivers that could help top line in the near term. One is this idea of AI and energy demand. Now, that doesn't really help with the energy transition, but it's a key driver of things happening in electricity land in the US. Just last week, we saw this announcement from Constellation and Microsoft to bring 3 Mile Island back online to power data centers. Now, I don't think that's going to be repeated too much because there aren't too many mothballed nuclear power plants out there waiting to get restarted. And ultimately, I think this is going to be a very good news for the wind and solar names. On the left-hand side on the screen, we think power demand from data centers is going to grow something like 4 to 10x by 2030. if you haven't seen it, we've got a cool report on this topic. Give me an email or a shout if you'd like it if you haven't seen it. But the other two pillars of electric power demand that I think is going to drive things in a positive direction for the energy transition. One is we are seeing the most profound spending on manufacturing in the U.S. That's probably ever occurred. This is the, on the right-hand side of your screen, you're going to see U.S. construction spending on manufacturing. Why does it suddenly tick up? That's passage of the Inflation Reduction Act. Also, the CHIPS Act is in there. So we're building a lot of new factories in the U.S. They're going to need a lot of power. We're also electrifying our transport in the U.S. and all the rest of the world, frankly, at this point. And so these three things are going to drive, in my view, some positive sentiment for the space. If we could go to the next slide. Most of this is the interconnection queue. These are all the projects out in the U.S. that want to get connected to the grid. By the way, there's about 1 terawatt of proposed solar projects in the U.S. alone. Now, they're not all going to happen per se, but there's a big pipeline out there of stuff that could get built if the incentives and market structure allow it. So I think there's a lot of runway to move to that 4x or 6x sort of energy transition spending that's necessary to hit net zero. Maybe we won't quite get to the dream, but we'll move in that direction. Now, what's it all mean for the companies in this space? We could get two more slides for me. So one is, this is the historical revenue for the U.S. Solar companies. Again, I already showed a version of this chart, but within the next couple of years, revenues from the space are poised to go from about 20 billion to 30 billion. I think 40 billion is easily within reach. And again, because this is a growth sector at the end of the day. These are not boring industrial elevator companies. These are names that should be geared towards rapid growth just because of all of the factors that Trina has laid out. Maybe before I hand it back to you, I'll hit one final point. Policy matters. We've kind of all heard about the Inflation Reduction Act. It's a terribly named piece of legislation because I don't know if it has much to do with inflation reduction, but it does have a lot to do with energy transition and clean energy. What we're seeing on the chart here is First Solar's gross margin, which is currently running at about 45–50% gross margin. That is kind of SAS or tech company kind of gross margin. If you get rid of the IRA, it probably drops in half or thereabouts. And so if Donald Trump wins in November, works with the Congress to change the U.S. law around this, and we'd handicap the chance of repeal close to maybe 10%. So this is not a big risk, but policy matters, and it could certainly affect not just the top line story for these companies, but also the profit story.
And part of the reason that we cap the risk of repeal for this policy is that it's actually really starting to bear fruit, especially in red states where a lot of this infrastructure is getting built out. So zooming out from just this one company and its profitability under the IRA incentives, if we look at the level of investment in low carbon energy supply nationally, where we saw this sort of flat line between 2020 and 2022, in 2023, when the IRA incentives began to kick in, and remember, we're still under this high interest rate environment, we did see investment really boost. So including, grids and other forms of clean energy, about a 25% growth. But if we just zero in on renewables, that was 60% growth in renewables investment between 2022 and 2023. And we expect that to continue this year into 2024 from everything that we've been hearing. I also just want to take a moment to go back to the financial institutions. Again, this is my focus, and I think one of the roles that financial institutions play is setting kind of a tone, an ambition level, and an appetite, and sort of their expectations for where these things are going to move. And I mentioned these ambitious sustainable finance targets. So we track them at BNEF, and between 2020 and 2023, we saw the size of these total aggregate targets triple. So now $18 trillion is pledged towards sustainable finance. some of these institutions set these targets in the past couple of years. Barclays actually increased the size of their target in just the past couple of years. So despite the sort of short-term hiccup, financial institutions are seeing the writing on the wall, and the energy transition is at this point relatively inevitable, and they're starting to make money off of this. So I don't think this is going away. And just to hit that point, even more macro, if we look at BNEF's projections for where the energy system is going to move out to 2050, if we have any hope of reaching net zero, what we're going to see is a huge build out of wind and solar to the tune of about 75% of electricity generation through 2050. It's going to be the cheapest and most economic way for us to hit our net zero goals.
Trina, I don't want to steal your thunder, but I just have to say, this is where we are today. This is where we're headed. Great kumbaya moment, a huge opportunity for the wind and solar names in this space. This is music to my ears. I hope we see this unfold.
Thank you so much.
So, Rob, it's not a kumbaya moment, it's an opportunity.